Hello, Josh and Grant here from Altera Advisors. Wanted to come to you because we've seen an uptick in market volatility recently through the first quarter of 2026 for a number of reasons, but largely driven by global conflict centering in the Middle East with Iran. And so we wanted to cover a few things briefly. The first is what's driving the current volatility. We'll talk a little bit about what history has to show us during times like this, and then bigger picture zooming out to see how should we think about volatility versus long-term risk when it comes to your planning. So getting started here, kind of where are we so far this year? Well, the S&P 500, which is generally a broad measure of the U.S. stock market, measures 500 of the largest companies. Through the first quarter of the year, was down about 5%, was down as much as 7 to 8%, and some benchmarks were down as much as 10% during the quarter, though we've seen some rebound in recent days. Again, as I said, largely driven by volatility in Iran related kind of conflict. It's uniquely impactful in the Middle East because it's such an energy-rich region. So conflict there tends to increase oil prices, which tends to have a domino effect, impacting inflation concerns and then impacting interest rates. And in general, when you think about the market, think about it as a big collection of individuals like you and me making decisions. When uncertainty increases, we don't like uncertainty. It makes it harder to plan, and the market volatility increases. And so this is where perspective on events like this becomes really important.
Yeah, and when we isolate these global conflicts specifically, like the one we're experiencing right now, it's often paired with short-term declines, like what Josh just mentioned, and a period of heightened volatility. However, over time, what we'll find is when you look at a 3, 6, or even a year later time period, markets historically recovered in most of the cases and moved higher in many of the cases. So, in other words, what we'll find is markets tend to refocus on the fundamentals, like the earnings of the companies that you and all of us own, and the economic growth that's persisting in the output of the economy. So let's take a look at this a little bit closer. So what we're looking at here in this slide is a lot of numbers on the screen here, but it's a list of global events and the resulting market impact. So on the right, it looks at some interest rate effects, and then in the center there, it talks about the change in the S&P 500, which we're using as our index for the equity markets, and the effects that happens in these events. And these kinds of headlines tend to drive a lot of anxiety, and you'll see these movements that we've been mentioning. So I want to bring your eyes down to the bottom of the screen. You'll see the last row says median. So this is the middle of the road on all of this data across all these events. And you'll see that 1 month, the in the middle is about a 1% recovery in the prices of equity markets after the start of one of these events. If you move out over time, you'll see a smoothing effect. 6 months, it's a median of 7%. And then 1 year, the median's 22%. So how's it going to be this time? We don't know. The point of the matter here is we tend to see the economy and the companies move back towards fundamentals and start trading based on what their actual earnings are as volatility starts to subside. If we zoom out a little bit and look at this a little bit bigger picture, we all know this. Our markets have navigated world wars, oil crises, financial crises, and more recently, a global pandemic. If you zoom in on any one of these, and let's take COVID 2020 there on the screen, that was a very significant event. And it was very anxiety ridden in it, and rightfully so. We've never seen anything like that in many, many years. And as you see, there was a pretty big decline there in that time period because of the significance of that event. However, as you start to zoom out more and look at this across from 1927 to 2026 here across all these markets, you'll see that there is a more smoothed out long-term trend of continued market upward growth, which is again, markets return to the fundamentals. What are the earnings and what are the growth of the economies?
Yeah, and this ends up we can extract from this one of the most important takeaways from our perspective, and that's that volatility doesn't always equal risk of loss if you have the right time horizon. So I'll talk about what we are looking at here in just a minute, but this is where we get to sound like really boring advisors, because in a lot of ways, the goal is use time-tested, reliable strategies that can get people the outcomes that we want. What are we here to do? We're here to help people take their wealth and use it to create lives they love, enjoyable experiences, impacts on loved ones, impacts on causes they care about. And volatility oftentimes shows up as a major threat to somebody's ability to do that. And so, why do we say things like, what's your time horizon? What's your risk tolerance? It's because those are the fundamental building blocks of some of the most reliable types of strategies. And so, um, when we take into account time horizon, we'll see the impacts of volatility and the chances of gain or loss. Okay, so what are we looking at here? Well, in the dark blue is a chance of a positive outcome, and in the light blue is a chance of a negative outcome. And then this is represented over different time periods. Okay, so on a daily basis, what this tells us is 53% of the days in the stock market are up, 47% of them are down. That sounds like a coin flip to me, and it's basically a coin flip. If anybody was trying to stake their long-term outcomes, the big picture things they want to accomplish with their wealth on a coin flip, most people are not taking that bet, and rightfully so. This is why we have time horizon based conversations first. Tell us when you want to use this money and what you want to use it for. We can then create targets to shoot for and help to plot the safety versus risk of those funds over these time frames. We talk about short term as anywhere inside of a year, maybe even up to 2 years, depending on the volatility someone might have, even in their own personal spending, uncertainties they have in their life. It's important to remember that volatility is not just global events, it's things happening in your life individually. But let's zoom into now 1 year. Well, this tells us that in 1 year, 73% of those years are up and 27% are down. So that starts to look more reliable, but that's still 3 to 1, basically. Let's go out over 5, 10, and 20 years. What this tells us is 88% of 5 year periods are up, 12% are down. That gap widens to 94% of 10-year periods are up, 6% are down, and 100% of historical 20-year periods have had some gain in the stock market. So when we talk about time horizon, it's because this is data historically that we can go back and look at. And then we talk about risk tolerance. Why? Because one of the critical things that we know can tank a retirement plan. If you're a client of ours, this will not sound new. One of the things that can tank your plan is short-term decisions with long-term money. If I have the money that's supposed to pay me my income for 5, 10, and 20 years, but when volatility hits, I treat it like a short-term decision and want to make major changes with my money, that's going to have massive implications. If we can take that time horizon-based approach and apply risk tolerance to it, we then can have good strategies that you can understand how they've performed over time. But then you can also try to, as much as anybody can, predict how you're going to try to behave during that time period. How are you going to handle risk when it hits? So this leads to a few important key themes to remember. The first is, well, something I didn't even put on here, and that's that whenever anything comes up like this, major global event, major personal event that represents some risk, it's going to feel really unsettling, and that's natural. That's the case for us. We're professional advisors, and major unexpected events feel unsettling to us. So what do we do both individually and then with clients to kind of walk through these things? Well, number one, we want to look at what history has to teach us. We want to take a goals-based, time horizon-based approach and see what history has to say about what has happened during times like this before. I'm going to sound like a broken record by now. Sorry about that. But it's why we always say investment strategy should be driven by your plan, including what happens when fill in the blank conversations. What happens when major global event happens? What happens when major personal event happens? How will we adapt and how will we react? The more we can try to talk that through ahead of time, the more we can create reliable outcomes for folks in the long run. We should expect volatility. We shouldn't be surprised by it. And most importantly, or maybe at least equally as importantly, let's say that, when people are concerned, they should reach out to their advisors for discussion and help processing through what to do. Because in some cases, changes are necessary. In many cases, when we're talking about shorter term volatility or events, a good, well-constructed strategy that's expecting volatility and some of these other things that we talked about may not need to change. But a good discussion with your advising team can help determine that. So with that, we'll sign off for now. Thank you for joining us. Hopefully this has been helpful, at least with some perspective on how to react to what we're seeing today in the conflict with Iran, as well as other future global conflicts like this. For more resources like this, you can visit alteraadvisors.com/insights, where we have a whole resource, a whole archive of articles on various topics. But until next time, hopefully this has been helpful, and thanks for joining us.